2025, Henry has $340,000 in his investment account. His coworker, same job, same salary, same first day, has $127,000. They did almost everything the same, except one thing. And that one thing, it looked like a mistake every single time Henry did it. By the end of this video, you'll know exactly what it was. And you might finally feel something a lot of investors never get to feel: actual permission to invest. If you've ever looked at the market and thought, it's too high right now, I'll wait, I get it. Feeling makes complete sense. The market breaks a record, and your gut says, this is a terrible time to buy. But what if that gut feeling is the most expensive instinct you have? This isn't about being reckless. It's about understanding what the data actually shows. And the research might surprise you. Not financial advice. Now, let's go back to where Henry's story starts. The year is 2000. Henry is 28. He's got $12 and saved everything he has, and he's finally ready to put it in the market. Tech stocks are on fire. His coworkers are talking about returns like it's free money. The news is all green, so Henry does it. All $12 in March 10th, 2000, the exact day the dot-com bubble peaked. Over the next 2 years, the market fell 49%. Henry watched that 12,000 shrink week after week. He didn't sell, but he froze, adding money. He stopped opening his brokerage app, and for the next 5 years, he put in exactly $0. Then 2007, Henry tells himself he's smarter now. He waits, he watches, he does his research, and he feels ready. He invests right before the 2008 financial crisis. The market drops over 50%, and in January 2020, he does it again. COVID crashes the market weeks later. 3 times, 3 peaks, 3 crashes. After 2020, Henry finally said something out loud he should have said 20 years earlier. I'm done trying to find the right moment. There is no right moment. There's only in or out. He chose in every single month, no matter what the market was doing. By every traditional measure, Henry is still the worst-timed investor you've ever heard of. But here's where it gets interesting. Now meet Sarah. Same office, same salary, same starting year. Sarah has one rule: never invest when the market is at an all-time high. She always waits for at least a 10% dip first. That's her system. That's what separates her from the people who buy blindly. 2013, the S&P 500 climbed over 30% in a single year. Sarah waited for her dip. It never came. 2017, market up 19%. Sarah waited. 2023, market up 24%. Waited. Sarah isn't being irrational. She's being careful. The problem is that careful has a price, and it doesn't show up as a loss in your account. It shows up as a number that was never there. It's the gains she didn't make, the compounding that never started, the time she can't get back. Between Henry, who always bought at the peak, and Sarah, who patiently waited for the dip, who actually came out ahead. It's not close, and it's not what you'd expect. Researchers at the Archbridge family office went back through S&P 500 returns all the way to 1990. They tested 3 approaches. 1, invest only at new all-time highs. 2, wait for a 10% dip. 3, invest on completely random days. No strategy, no timing, nothing. The strategy that came out on top, investing at all-time highs. It beat waiting for a dip. It even beat random days. I know, it sounds backwards. But give me a minute and I'll show you exactly why it's not. All-time highs don't show up alone. They cluster. During a real bull market, one driven by actual earnings growth and a healthy economy, the market doesn't hit one record and stop. It hits record after record. That's what a bull market is. While Sarah is sitting on the sidelines waiting for her discount, the market climbs another 5%, then 10%, then 15%. And when her 10% dip finally arrives, she's still buying at a price higher than where she first decided to wait. It's like waiting for a sale at a store that raises its prices every week. Even when the discount hits, you're not getting a deal. You're getting less of a loss. And here's what nobody says out loud. Every month Sarah waits, Henry's money is compounding. Dividends are reinvesting. The account is growing quietly, with no drama, no headlines. Time in the market isn't exciting. It won't show up in your newsfeed. But it's the one edge in investing that you genuinely cannot manufacture later. You can earn more money. You can't earn back the years you sat out. Hartford Funds went back through decades of S&P 500 data and looked at what happens when investors miss the market's best days. Just the 10 best days over a 20-year period, you lose more than half your total returns. Miss 20 days, you lose over 70%. 70%. Gone. Not from bad investments, not from panic selling, just from not being there. And here's the part that really stings. Those best days don't happen when everything feels calm. They happen right after the worst crashes, when fear is at its highest, when every financial headline is telling you to stay out. Sarah was waiting for things to feel safe before she got back in. The recovery didn't wait for her. And look, none of this is Sarah's fault. Well, probably not yours either. Here's what's actually happening under the surface. Your brain wasn't built for investing. It was built to keep you alive. And one of its core features is loss aversion. Losing money hurts about twice as much as gaining the same amount feels good. So when the market hits an all-time high, your brain doesn't see opportunity. It sees a cliff. That feeling, it's too expensive, I'll wait, isn't financial wisdom. It's a survival instinct that kept your ancestors alive. In the stock market, it just keeps you on the sidelines. Your brain is genuinely trying to protect you, and it's costing you. So what's the actual move? Not throw money at the market and hope for the best, but also not wait forever for a perfect moment that never arrives. The answer is simpler than both of those. Invest a fixed amount on a regular schedule, no matter what the market is doing. When it's at a record high, when it's down 20%. When you genuinely don't know what's going to happen next, you just keep going. This is called dollar cost averaging. It works not because it's clever. It works because it takes your brain completely out of the decision. There's no timing to get wrong. There's no entry point to wait for. Remember what Henry said after 2020? There's only in or out. He chose in. Every month. That's it. That's the whole strategy. One more thing, and this one matters more right now than it has in a long time. Everything we covered today is based on the US market. And the S&P 500 has been genuinely excellent over the long run. But it's carrying more concentration risk than most people realize. Research from Rockefeller Capital Management shows that tech stocks alone now make up around 41% of the index. It's a concentration level we haven't seen since the dot-com bubble, the same one that took Henry's $12,000 and cut it in half. T. Rowe Price points out that the MSCI All Country World Index holds over 500 stocks compared to the S&P 500's 500. That's a very different kind of bet. And Guinness Global Investors found that when you compare the market cap weighted S&P 500 to an equal weighted version of the same 500 stocks, the gap tells you everything. A small handful of mega cap names are carrying most of the index's recent performance. If they stumble, the whole index stumbles with them. The S&P 500 isn't a bad investment. Just make sure you understand what you're actually buying. Back to Henry, 2025. 340,000. 3 peaks, 3 crashes, and a portfolio that more than doubled his coworkers. Not because he was smarter, but because he got lucky, because he stopped leaving. The market didn't reward Henry for his timing. It rewarded him for not quitting. If you've been sitting on the sidelines, watching records get broken, telling yourself it's too high, it's not the right time, the data has a pretty clear answer for you. The right time has probably already passed, several times. Have a comment with the one investing question you've been afraid to ask. I read every single one. Subscribe if you want more of this. Research-backed, no fluff, straight to the point. And whenever you're ready, start.